Welcome to the IRS Debt and Audit Podcast with Brian Logren.
Hello and welcome back to the IRS Debt and Audit Podcast with Brian Loughran. Brian is a seasoned tax attorney based in Tampa and the founder of Tampa Tax Relief for more than 25 years. He's helped individuals and business owners across the country resolve serious IRS problems from audits to tax debt to cases in the U.S. tax court. I'm Evan Mack, and today we're talking about how the IRS evaluates a taxpayer's ability to pay when someone owes a significant tax debt. Brian, kind sir, welcome back.
Hey, Evan, good to see you. Thank you.
Good to see you too, sir. Brian, when someone owes the IRS a large tax balance, the agency often evaluates what they call a taxpayer's ability to pay. What does that concept mean in the context of IRS collections?
Well, it's kind of a general term, and it means exactly what it says. What is their ability to pay? But the key here is, what is their ability to pay in the eyes of the IRS, not in the eyes of the taxpayer? And I mean, obviously, people would say, gosh, my ability to pay is on a $1 million balance is $10 a month. Well, of course, as people are going to want to do what's most advantageous to them. But the IRS is the same way. The difference is, as a government agency, they have certain parameters and rules that they have to adhere to. So when they start talking about ability to pay, it really funnels into some very specific guidelines. But what I tell people is there's some gray area to work with, but really the key is to just understand the IRS is going to try to collect as much as they can, as fast as they can. But we want to put something in place that is going to be a situation that is acceptable to the IRS, but also reasonable or livable for our clients.
So in general terms, what types of financial information does the IRS look at when trying to understand someone's financial situation?
Well, once again, it boils down to what it's called. It's called the income tax, at least as to individuals, and it's based on income. And it's sounds a little bit flippant, but it's true. No income, no tax. But the first thing the IRS looks at in an ability to pay situation is, what is the income of the taxpayer? And although income is figured on an annual basis through the tax return, with the IRS, when they're talking about any type of installment agreement or payment plan, even a partial payment plan or partial pay, everything is configured down to a monthly amount, meaning everything is boiled down to either divided by 12 to a monthly, or in some cases, people have certain types of maybe income or expenses that are quarterly or semi-annually, but everything filters down to a monthly amount, both as to income and as to expenses, and of course, the ability to pay.
How does the IRS typically review income and expenses when evaluating whether a taxpayer can, realistically pay down that tax balance?
And again, we're talking about a situation not where somebody has a complete inability to pay. Say somebody's income is drastically, or they're in a no-income situation, or maybe they're pursuing an offer in compromise or an innocent spouse claim or something like that, or even in bankruptcy. We're not talking about those situations. We're talking about situations where people have substantial balances, and they're obviously unable to just simply pay them off, and they need to put something in place, i.e. a payment plan or installment agreement. So just to be clear, it's not taking it at people that truly can't do it. But really, the IRS's roadmap, or I say their blueprint, is bank statements. And really, because most people, if they're a W-2 wage earner, or even a lot of 1099 people, say real estate agents, it's a direct deposit. There aren't that many places seemingly anymore that issue a paper check every other Friday. If you're an employee, you're going to get a direct deposit, obviously going to a bank account. And since the banks are regulated by the federal government, the Department of Treasury, when the IRS reaches out to those banks and says, hey, we want to get a copy of bank statements, bank information, of course, the banks are going to comply, simply because they have to keep their bank charter. So bank statements are the number one blueprint or roadmap for the IRS. That's their starting point, both as to income, usually as to income, but also as to expenses.
Why can the IRS view of someone's financial situation sometimes different from how the taxpayer sees their own finances?
Well, it's because ability to pay, when you get down to income and expenses, the expenses on the IRS's viewpoint are deemed as what they call allowable expenses. And that's simply things such as a mortgage or rent payment, a car payment, auto insurance, out-of-pocket healthcare premiums you're paying, again, monthly or quarterly, annually, what have you, utility bills, food and personal care products. Those all fall under the umbrella of allowable expenses. On the flip side, you have a situation where taxpayers say, well, I have certain expenses that I'm obligated for. I've contracted, say, for instance, a 24-month arrangement to pay buying something. And if it's not something that falls that allowable expense, it's a situation where the IRS can say, look, we know you have that obligation, but we're not going to view that as an allowable expense against your income. So therefore, they just treat it as if it doesn't even exist.
So Brian, can you describe a situation where the IRS's evaluation of someone's ability to pay became a major factor in resolving a case?
Well, it's really, I just say in most cases, it really does become a big factor as to the allowable expenses. And what I mean by that is that certain things are deemed obviously allowable, such as a mortgage or rent payment, a car payment, auto insurance, utility bills, food and personal care products. I mean, those things, I mean, the IRS understands everybody has to have those. Um, Without going into too much of a deep dive on the parameters on those, but you then have a situation where taxpayers maybe have obligated themselves to another debt that, say, they sign a 24-month contract or 36-month contract. It could be maybe for the purchase of an item like a four-wheeler or a jet ski, or it could be a situation where it's contracting for private horseback riding lessons for their 8-year-old daughter. The IRS says, look, we see those expenses, but we don't deem them as what we call allowable, meaning we don't believe that those amounts fall outside of our ability to collect from you. So the IRS would look at those and say, well, yeah, your payment this obligation is, say, $400 a month. As far as we're concerned, we want that same 400. And so that's where some of the heavy lifting comes in.
So when the IRS reviews an asset like property, bank accounts, or other holdings, how can that influence the way the agency approaches that collection?
Well, that's interesting because what will happen in almost every case where you have a substantial balance, and I'll just put it, say high five figures and into the low six figures and above, 80,000, 100,000, somewhere in there usually, but not always exactly that much. The IRS oftentimes will file a federal tax lien against the taxpayer. And as we've talked previously about tax liens, it attaches to everything the taxpayer owns and everything they're to future acquire while that lien is in place. But more specifically, a lot of our clients are homeowners, and most of them have some type of a mortgage, but nevertheless, it attaches to the property, the real property. And so it encumbers it from sale. But the IRS will come in and say, listen, if there's equity in this real property that you own, whether you own it completely outright or even if you're paying a mortgage, the IRS will say, let's look to tap into that equity. What a lot of people think is they think the IRS is going to make them sell their house or they're going to take their house. And I say, listen, the IRS isn't a Century 21 or Remax. They don't want your house. What they want is maybe some of the equity in it. And so the IRS will oftentimes ask people to try to secure a second mortgage or home equity loan against the equity in the property. And in many cases, that just doesn't work because if the IRS has filed a federal tax lien, there aren't too many lenders that are going to want to lend against that same property that now has a federal tax lien. As to other types of property, such as cars or even personal products like televisions and some jewelry and I don't know, golf clubs and things like that. I mean, again, the IRS, as I've said before, they're not eBay, they're not Craigslist. They don't want your used golf clubs. They don't want your used 52-inch color TV that you have in the garage. They don't want your jewelry, and I'm talking normal kind of jewelry, not obviously some collection of Tiffany's that's worth $1 million. I'm talking normal jewelry that people have. They're not interested in that, and they're not even necessarily asking people to sell that those items and get rid of them and turn over the money, but they're looking at, as I say, income more than anything, more than property. But there are some situations where I've had clients that own maybe a collectible car that's worth quite a bit, or maybe they have some type of artwork or other types of collectibles that are worth quite a bit. I mean, in some cases, the IRS wants them to liquidate, but again, it really boils down to if the person can liquidate it in a reasonable fashion. And so you have a lot of things that go into these equations.
So, Brian, how does the financial evaluation connect to possible resolution paths like installment agreements or other collection alternatives for the person?
Well, you're going to have to go through that whole financial situation to come up with some type of installment agreement. Again, in those situations where the people are looking to pay out on it and the IRS is saying, look, we need to get paid or else. And the or else obviously is things like a bank levy or an accounts receivable levy or a wage garnishment. So those are things that I tell people we absolutely want to avoid. And I've told every client, I said, if you follow my direction, that's not going to happen. And it's never happened with us in all the years we've been doing this. If people followed our direction, we've never had a bank account seized. We've never had a wage garnishment if people are following our direction. But unfortunately, a lot of times people wait till something like that happens before they call. So we want to avoid it. But I want to say one other thing about property. The IRS looks at income as property, meaning the income that you're earning today, next week, next month, the IRS is looking at that. And really, that's what they're interested in, more so than you selling your television or your collection of Hummel dolls or your dog's water dish. They understand the reasonableness of liquidating personal property like that. It just doesn't make sense. And the IRS isn't going to micromanage a garage sale. So they're really looking at income. And of course, the first reaction from people is, well, income, I use that to live on. And I always tell people, yeah, you do. And everybody does. Even billionaires use their income to live on. And Warren Buffett flying around on a jet, I can assure you, he's using his income to pay for that. He's not pulling, $100 bills out of a big stack in a closet. He's looking at his income, paying his expenses. So we want to limit the IRS's ability to attach income, obviously. Because if you find yourself in a wage garnishment situation, you could be looking at upwards of 90% of your net pay being taken.
Wow.
If you're a 1099 independent contractor,
Wow.
you could be looking at 100% of it being taken. So you really want to avoid that. But putting together a financial statement, it definitely it takes a lot of work. It's important how it's presented, but it has to be done. And to ignore it is inviting just the worst possible situation.
So, Brian, where do most people often misunderstand how the IRS approaches these financial evaluations?
Well, a lot of times people say, well, I've got credit cards I'm paying on, and I bought, like I say, I used an example of a jet ski or a four-wheeler or motorcycle, kind of a big boy toy type thing, or somebody's contracted. I get a lot of situations where people have children under the age of 18 that they really want to open their world. They're, buying private horseback riding lessons for their daughter, or they've got
Right.
their 13-year-old son in junior hockey and he's a goalie, and about every 3 months he has to get new equipment. And I mean, those are very, very expensive endeavors. And they'll say, look, I'm committed to that. I signed a contract. I'm obligated to pay it. I can't just back out on it. And as I say, the IRS says, look, we're not asking you to, but what we're saying is the money you're spending on that, starting off, we want that to us every month. So the client's saying, well, what do I do? I mean, how do I find myself in a situation where that same money I'm obligated to on a contract, I'm supposed to be giving it to the IRS? And so a lot of times you really have to kind of work through things. And it isn't always a black or white, yes or no type situation.
Right.
I go on and on about how some of those things fine line them way out. But as I say, that's the heavy lifting part. That's the part that takes time. And when the IRS is looking at a financial statement or financial situation, they don't expect to have an answer in 24 or 48 hours. They understand it can take some time to really compile that information and really present it.
So, for someone, dealing with a serious tax balance and facing questions about their finances, what should they understand about having a tax attorney involved when communicating with the IRS, Brian?
Well, I've said before, when you have a tax attorney, it tells the IRS that you're taking the situation very seriously. Okay, so that's number one. And number two, if the person's knowledgeable, they're going to know how to present the information. And I said before in another podcast when talking about audits, sometimes how you present the information can be as important as the information itself. I think a general concept that people have about taxes is that it's just black and white. It's 1 + 1 = 2 and 2 + 2 = 4. And in the tax world, it's not like that, because if it was, you wouldn't have people. You just have software programs that did everything. Now, if you have a very, very basic, simple tax return with one source of income and no deductions, well, obviously you have that situation. But for our clients and for most people, as they go through life and they start achieving and earning, it's a lot more complicated than that. So you have to have somebody that knows how to present the information and really to understand the IRS's perspective and also what the IRS can and can't do when it comes down to a situation trying to put an installment agreement together. It's important that you just take all those things into consideration.
Mm. Brian, thank you so much for your time, sir.
Well, thank you, Evan. Appreciate it.
All right. That's it for today's episode of the IRS Debt and Audit Podcast. To learn more about Brian Lochran and his work helping individuals and business owners resolve serious IRS problems, visit tampataxrelief.com. Thanks for listening, and don't forget to like, leave a review, and share this episode with someone else who might need it. Thank you so much, and we'll see you next time.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.